Okay, welcome everybody to the slightly delayed podcast brought to you by Sygnia Limited on the budget that we've just had. In fact, as I was thinking through this delayed recording of the budget, it struck me that actually we may have timed it to perfection, because my sense has been always year on year that there is so much noise and media articles and discussions and TV interviews around the budget that in fact it's very difficult to step back a little bit in a quiet corner and distill what the true messages have been from the budget. And so perhaps now that the din and the noise has subsided around the budget, we can look back a little bit more carefully to see what the budget actually delivered for us as South Africans. My name is Harun Bhorat. I'm chairman of the Sygnia Limited Group and also co-chair of the investment committee for Sygnia. So I'll bring to you some of the takeaways I have in particular around the budget that we've just seen for 2024-2025. I'm going to try and segment the discussion around sort of 3 or 4 key areas. I will foreground the outlook for growth, which I think is really important in thinking about budgets and thinking about the MTF, the medium-term expenditure framework in particular. I will talk to deficits and the debt position and the fiscal consolidation path that the National Treasury has laid out. And of course, the much spoken about GFECRA, the gold and foreign exchange reserve account, and how that may be managed going forward, together with SOE bailouts and a sort of quick look at the revenue side. But there is, stuck between those two, a little bit of an analytical sidestep, if you like, which I think hasn't been raised in most of the overviews of the budget, around what I think are incorrect assumptions around the public sector wage bill and the social relief of distress grant in the budget figures that we've seen. And I think if we take those into account, the deficit starts looking a little bit different to what has been laid out by the MTF and budget documentation. And then I'll conclude with some of the early proposals and notifications around cryptocurrencies and, of course, the two-part retirement system. Okay, so let's get going. I want to, think about the growth environment in particular, because I think if one thinks about the economic growth environment, we often settle on what I would call the standard assumptions around projections for growth for the period 2024. Now, in the first instance, that's really important, because what it is a representation of revenue flows that will be allocated to government from economic growth. So higher economic growth, higher tax receipts, more to spend. Simple. So the growth projections matter. And we know that the growth projections for South Africa are not good, right? The median consensus, so what I have here, are growth estimates for across the sort of 6 or 7 macro models, the macroeconomic models run by everybody from the IMF and the World Bank through to the BER at Stellenbosch University. SARB has its own, and so does Treasury. The consensus places us at a median of 1% growth rates for 2024. Interestingly, you've got the IMF and the BER at 1.8% instead of the 1% for most of the other models. These, just to be clear, these kind of projections will change sort of every quarter as new data comes in. I want to, though, refer to the red parts of the bar that you see in front, the bar graphs that you see in front of you. Those are what I call the no infrastructure backlog potential growth rate. Now, that's not the standard potential growth rate you see in macro models. This is my assumption of what growth rates could have looked like if we didn't have the infrastructure growth rates that we had. So how do I think about that? Well, in many ways, if you look at the 2021, 2020, so pre-2024 relative growth rates, so if you look at South Africa's growth rates relative to the world or emerging markets, we were somewhere between sort of the world and emerging markets were growing sometimes somewhere between, let's say, 0.5 to maybe 1 times faster or 1.5 times faster than South Africa. What has happened now, if you fast forward, right, is that South Africa is now, or the rest of the world and emerging markets are now growing between 3 to 5, and in some cases 7 times faster than South Africa. Now, the rest of the world and emerging markets are not growing faster due to their own internal sort of positive growth spurts, right? We know the rest of the world economy, perhaps outside the US, is struggling tremendously. China is struggling. Emerging markets outside of China are struggling. So, in fact, the reason for the relative growth rates being so much higher in the rest of the world and emerging markets is to do with what we call South Africa's own goals. It's to do with the fact that we have massive infrastructure constraints, ultimately, that constrain our growth rates. If we were growing without these infrastructure backlogs at the same relative growth rates, so 0.5 to maybe 1 times, and I've sort of mixed them up in these calculations, our growth rates could have been anywhere between 3 and 5.4% for 2024. This is similar to the SARB's reference to how Eskom's collapse has shaved off 2 percentage points off economic growth rates. And I think that for me is a really important lesson about the missed opportunities of 2024. We could be looking at growth rates that are in some cases 3 times higher than what we currently have. So I think that's a really important point about the extent to which infrastructure has constrained our economic growth forecasts. I want to, though, turn more specifically to the budget, and in particular, how we think about the fiscal consolidation path, deficits, and our debt to GDP ratios. Now, if you look at the budget deficit, probably the core indicator that one looks at when one examines budget releases from any government, in the bottom row, hopefully if you can see the cursor, in the bottom row, you have what is effectively the budget deficit to GDP ratio, what is referred to as the budget balance. You'll notice that it came down quite nicely to 2022-2023 financial year and is now upped sharply to just under 5%. That's a startling 36% annual increase in the budget deficit to GDP ratio. Now, this has not been emphasized enough, right? So already we're hitting a close to 5% deficit to GDP ratio based on last year's change. There is, though, a very, very strong signal, and I think that's very clear from National Treasury, that they are aligned to a fiscal consolidation path that's going to reduce the deficit to GDP ratio. And so what you're seeing across what is called the medium-term expenditure framework, so apologies for those who know these terms, but across the MTF period from 2024, 2025, right through to the 2026-27 financial year, right at the bottom, you'll see how the projection is for the deficit to GDP ratio to decline steadily. And that number is really important, right? So the Treasury is hanging its hat on a decline across the MTF period of the deficit to GDP ratio from just under 5% to 3.3%. And I'll come back to that number and, to be honest, the veracity, the believability of that number over this period. What's not shown here, well, I suppose you could derive it, is the fact that Treasury has managed to achieve a primary budget surplus. So if you recall, the primary deficit or the primary surplus is when you exclude interest expenditure. So if you only look at non-interest expenditure, it turns out that Treasury has actually been quite positive, right, in reporting a primary budget surplus. I'll talk about how that came about. But as a statement of intent, the primary budget surplus is really, really important. I believe that it signals that the new leadership of National Treasury under Duncan Peterson and various new, young, very smart DDGs at National Treasury are signaling that fiscal conservatism is back at Church Square. And I think that's a really important signal in terms of signal to markets in terms of the intent to maintain and keep South Africa on a fiscal path that is at least manageable in terms of growth. How was the surplus achieved? And this is the good old GFECRA, the gold and foreign exchange contingency reserve account that none of us had spoken about at all 2-3 months ago, and we were all talking about it 2-3 months later. If you look at the primary balance, so the graph on the left indicates, if you like, the primary deficit across the fiscal years, and you'll notice that effectively we're running a surplus, as you saw, as I indicated in the previous graph, previous table. We're running a surplus from this fiscal year through to the next over the full MTF period. The red bars indicate the contribution of the GFECRA. So as we know, the draw on the gold and foreign exchange reserve account stands at 100 billion. What that manages to do in the immediate sense is to turn the primary deficit, right, into a surplus. So in essence, without the GFECRA, we would not have been able to run this primary surplus. Note, though, that the draw, right, according to Treasury, the draw and Treasury estimates, the draw on GFECRA is not required, even though it is 25 billion for the 2 outer years, is not required to run a primary surplus. And I think that's a really important point. Again, signaling Treasury's intent to maintain a path of fiscal conservatism. I will turn to GFECRA in much more detail later, but in essence, it's a reserve account held by the Reserve Bank, which has allowed the rand value of that account to rise dramatically, given, ironically, the weakness of the rand, but also has allowed rising gold prices to accumulate on the reserve account. Ironically, the weakness of the rand has come to the budget rescue of South Africa, or the fiscal rescue of South Africa. I am, and I'll turn to this a little bit later, I am worried about continued ongoing use of the account, particularly as political parties and political leadership changes, and the temptation to dip into the account or to change the framework that's been established for GFECRA, again, something I'll come to later, maybe too large for new political leadership in some instances. And so this is something that needs to be very, very carefully watched and monitored in future years. But there it is. I don't think the GFECRA is going anywhere now. It's probably going to remain a feature of our budget landscape for years to come. But the real story, arguably, around the deficit and around debt is the nature of, and the changing nature of the next 4 to 5 years of bond redemptions. In fact, National Treasury has signaled this very, very strongly. Again, an indication that they don't want to hide behind any of the figures. They've signaled in the estimates of expenditure report, and I quote, South Africa's government gross loan debt as a percentage of GDP is at its highest point since 1947. That's Treasury's own words. And one of the key reasons for this is these principal debt payments that are due to bondholders over the next 8 years. And you can see from the graphic, these were fairly manageable or small in relative terms until we've hit, if you like, this fiscal period. And over the MTF period, we will note that these bond redemptions will average 250 billion between the periods 2024 and 2032. And if you want that as a comparator, over the previous period in the last decade, the average foreign and domestic debt redemptions stood at 61 billion. So what we have now is a stock of debt that is due for payment, right? That is now 4 times what it has been in the previous decade. So I'll repeat that. We now have a stock of debt due for payment. The principals are due for payment, and that value now is 4 times what it has been in the previous decade. For those who want to think of it in simple terms, just think of ourselves as becoming close to a delinquent debt debtor based on really wasteful expenditure, corruption over the last few years, in particular under the Zuma period, and that those chickens have come home to roost in terms of massive debt payments. The figure that's often quoted is our debt to GDP ratio, and you see that reflected in these numbers over the period here from 2018 to 2032, and the evolution is stark. So what you see is in the first instance a debt to GDP ratio that is increased by about 20 percentage points, from about 51% to about 70 odd percent over a 5-year fiscal period. That is a massive increase over a very short time period. So we've got this ratcheting up of our debt to GDP ratio, which places the Treasury in exactly the kind of difficult position they are in. But Treasury's signal, and you'll see the black line, is what was promised in the 2023 medium-term budget policy statement. That was the fiscal consolidation path to 2032, which would see us declining, debt to GDP ratio declining to about 72%. Treasury has now revised those estimates downwards, which is a good sign. So in other words, they've now revised the consolidation path as reaching 67% by 2032. This for me, reiterated in my previous to reiterate my previous statement, is a sign of a new leadership in National Treasury that's far more serious about fiscal austerity. The fact that the DG has mentioned was used the notion of a fiscal anchor as part of future discussions within Church Square, I think is another good sign that far more care is going to be taken with respect to managing our debt to GDP ratios. The number that we often look at is the debt service costs. So the portion of our expenditure that annually is allocated to interest payments on debt. So not just the principal, but the interest that's due. Not only is the principal starting to accumulate, as we saw in the previous graphs, but of course the interest is due, as is most interest, on a regular basis. Debt servicing costs, right, to just unit base that, is about 21 cents of every rand of revenue. Now, if you wanted a relative figure, a decade ago, that was 11 cents. So again, our delinquency in terms of debt has grown dramatically over the last decade. And what Treasury is signaling, to be clear, is we are aware of this. And our attempt is actually to bring this component of our expenditure profile down as quickly and as dramatically as we possibly can, based on assumptions, of course, around revenue flows, around GDP growth, and so on. And some of which, I should add, just as a sidebar, some of which can change in a positive way and some of which can change in a negative way. Those debt servicing costs are going nowhere because of a history of low economic growth rates, of course, born out of COVID, but in particular, I would argue, the underlying long-run trajectory of wastage and corruption in government, which I think under the new regime, there's certainly been an attempt to turn around. And I think that's important to keep in mind. So it's the legacy of the Zuma presidency and state capture that has given us this kind of fiscal environment. One thing, though, that we often, and so just to be clear on these debt service costs, those are the second highest item after education in the budget, right? So when bills need to be paid, we're paying schools and textbooks and teacher salaries first, and then we're paying the interest bill. So if one thinks of orders of magnitude, that's how large the interest burden is. And I think that really has to be kept in mind, particularly in terms of populist demands for greater deficits and so on. If one thinks about the debt to GDP ratio, which I showed in the previous graphic, just to remind you, that does this. Yes, there is a decline, and it is an aggressive decline, more aggressive decline than the MTBPS promised. But what I worry about is a figure that shows me this, that when I look at debt to GDP ratios by country, South Africa's debt to GDP ratios, and again, to be clear, I use an emerging market sample. So we've got the Mexicos, Turkey, I've got Botswana, Malaysia, India, Thailand, Argentina, Brazil there. South Africa is way too high on that list, right? So if you look at the list of sort of 15 odd countries I've got there, South Africa's got the fourth highest debt to GDP ratio. We sit behind, to be clear, Argentina, Brazil, and Pakistan. So for me, that indicates that even if we drop to, and let's just be clear, if we drop to the 67% that's in the fiscal consolidation path to 2032, at least based on these numbers, we'd still be the fifth highest in the list. So we're nowhere near as austere as we should be in terms of debt to GDP ratios. And I think those kinds of international comparisons are really important to compare ourselves against the benchmark of other middle income countries that have similar challenges to ours. And in particular, if you look at the mean or the median, it sits at about 50% for the sample here. This data is drawn from National Treasury and some of it from the IMF. And essentially, we are about 50 percentage points above the mean in terms of debt to GDP ratios in the emerging market sample. And I think that's a sort of a really wake-up call for the extent to which we need to be aggressively looking at our debt to GDP ratios. That being said, there's always a concern around the levels of debt and the debt management strategy of Treasury, National Treasury. And just to be clear, like most corporate entities, that the National Treasury also has its own debt covenants that are in place. And I've just provided these as information and also as a guideline for those that are looking at the various forms of debt that Treasury is taken on and the covenants that are set out. So you can generally see that the Treasury is within in almost all covenants that it's set, almost comfortably within the limits that are set. There's often a concern around the component around foreign debt, and you'll see there that the benchmark or the covenant around foreign debt as a percentage of total debt is about 15%, and the estimates going forward stand us at about 10%. So Treasury is well within the limit of foreign currency debt, for example, and well within the limit of all the different types of debt that you see there, whether it's Treasury bills, long-term debt, inflation-linked bonds, and so on. So all comfortably within the limits. But there is a concern if one looks at the term to maturity of total debt. That sits at between 10 to 12 years, depending on the whether it's foreign debt or aggregate debt. And that 10 to 12 years maturity period is higher than the average emerging market. And that's something I think for financial economists to keep an eye on and perhaps look at more closely. What about the ownership structure of domestic bonds? So just to be clear, these are only domestic bonds, and we're asking the question, how has the ownership structure changed? And I think one of the important signals we see, again, in our terms of our debt profile, is that foreign investors still account for the highest share of bond ownership at about 25.3% of all local government bonds in issue. But that has declined, and it's declined dramatically from a high of 41% in 2017. And I would argue that's almost principally due to the view that South Africa post and during the state capture and Zuma era became far more risky. Of course, there were at more attractive yields elsewhere in the world, but in essence, the combination, I would argue, but disproportionately, the changing risk view of South Africa has resulted in a declining share of foreigners owning South African bonds. And so it declines by over 10 percentage points from 36.4% to 25.3% in the decade, from 2013 to 2023. So there is a very strong preference function amongst foreigners indicating more aversion to South Africa's economy, South Africa's government policy and views on corruption and the like. Domestic pension funds, though, have also moderated their demand. And so the consequence that other institutions in the financial services sector have actually increased their holdings from about 5% to about 22%. So there's been a fundamental shift in the changing, in the ownership structure of domestic bonds. And again, I think that's a really important signal for changing risk appetites amongst bond purchases in South Africa. So in sort of concluding this section around debt, deficits, and the consolidation path amongst National Treasury, I think it's really important to emphasize a few things. Treasury has inherited a fiscus from a previous era that has not only institutionally been struggling, but struggling also with low growth, partly globally induced, but as we indicated, very much a function of collapsing infrastructure. So I think that's a really important backdrop that Treasury, frankly, has very little control over. The extent to which growth rates can be kicked in. Certainly on the state-owned enterprises side, Treasury probably has a more proactive role that it can play. But it's important to keep in mind that this is a debt position that's evolved, and it's evolved over a decade, as I've indicated many times now already in this presentation, a decade of populism laced with state capture and the looting of state-owned enterprises. And I think that those chickens have come home. Those fiscal chickens have come home to roost now. It's clear, though, that the Treasury has indicated its willingness to tackle these on. And I think that's the positive signal I take from that. But what's really important to recognize is that the National Treasury does not operate within a technocratic vacuum, as we all know. And so there are certain key expenditure items, and I'll turn to these now, that are subject to political and other trade-offs that Treasury and Treasury's senior technocrats may have very little control over. And I think that, for me, remains one of the uncertainties. And so here's a signal as to one of the challenges. If you look at compensation of employees, as a share, there's public sector employees as a share of GDP, South Africa is the red bar. So in the sample, which is both middle and high income countries, South Africa is the sixth highest in the sample, spending about 15% as a share of GDP on public sector workers' wages. Now that's significantly high in a sample where the median is 11% and the mean is 10%. And so that's, again, a signal as to how important, for example, the public sector wage bill is in terms of expenditure allocation, and how in annual adjustments, the National Treasury may have very little say over where one lands with the wage bill. And so with that, I turn to what I think are the two assumptions in the MTEF, in the budget statement, that I worry about the most. And these are firstly the public sector wage bill and the social relief of distress grant. So the current assumption, just to be clear, before I take you through these numbers, the current assumption is that the public sector wage bill adjustment over the MTF period will be 4.5%. So I'll pause there. Just think about that. That means, and it's been in the papers recently, that government will sign off and public sector workers will agree to a 4% inflationary adjustment over the next 2 years. We've already seen, right? We've already seen vehement disagreement from key parts of the public sector union movement contesting the 4.5% adjustment. So in my view, and of course that then feeds into the budget deficit, right? In my view, the 4.5% public sector wage adjustment is not credible. I think what you're more than likely to see, and these are the numbers and the simulations I've done here, and this is probably on the low side, is an increase of about 7.5% or 8%. And so I asked the question in the graphic and the table that you see there, what would the deficit look like if the wage bill increased, the wage bill adjustment was 7.5% as opposed to 4.5%. So in the first instance, with the 7.5% increase, the wage bill. So currently the wage bill is assumed to be about 788 billion, right? But with a 7.5% increase, instead of the 4.5, I showed here in the first red bar on the left, the wage bill goes up to 833 billion in the 25-26 fiscal years. But in the outer year, it goes from 822 billion to just under 900 billion. So what does that mean in terms of actually meeting budget deficit projections? Well, alone on this one change, right? The original budget deficit, as you can see in the bottom row here, and you recall this number from the beginning of the presentation, went from 4.9% to 3.3%, right? So that was the assumption based on a 4.5% wage bill adjustment, which I do not believe is credible. The budget deficit, in my view, on a 7.5% wage bill would actually go from 4.9%, which is baked in already, let's assume that doesn't change, to 4.1%. Now that's a dramatic adjustment just on one change around the public sector wage bill. I should say that there could be some nifty footwork by Treasury if it is saved, and this follows through for the rest of the simulations I do, if it is saved by things such as a resource run, which sees massive increases in revenues, or growth rates return because we've fixed infrastructure backlogs and so on. So one could still maintain 3.3% deficit if other factors kick in to pay for this higher public sector wage bill. That we can talk about that later, but of course that then talks to the style of budgeting, whether all we're doing is feeding higher public sector wage bills through additional funding, unexpected funding that's generated from higher growth rates. I'll turn to that right at the end. But the other, if you like, assumption that I question in the budget documentation is the social relief of distress grant. So this has now been extended multiple times, currently due to end next year in March. There is no provision in the budget documentation for its extension. Now, the numbers are much, much smaller. If we look at the allocation, and here we assume a 4.5% increase over the 2-year period, you've got about 75 billion that's required over the 2-year period to fund the SRD. The impact on the deficit is not as large. So instead of the deficit ending at 3.3%, it's not insignificant. You add about 0.4 percentage points to the budget deficit if the SRD is extended permanently. And so our budget deficit, instead of being at 3.3% at the end of the period, ends up at 3.7%. And so again, the SRD maybe interesting discussions about alternative uses of the SRD budget envelope, but let's assume that it stays, at least the amount is brought on budget. Well, the first thing that happens is that the assumed expenditure rises on the public sector wage bill and continuing the SRD from about 789 billion to 870 billion. And in the outer year from 823 to about just under 950 billion. Okay, so that's just on 2 items, right? The wage bill and the SRD. The key, though, is what happens to the budget deficit. So you'll see the budget deficit projection 3.3% in the outer year. Well, if you stick to the 7.5% public sector wage bill, which I think is far more believable, and the SRD remains in place, your budget deficit, ceteris paribus, ends at 4.6%. So in other words, you've got a much more elevated deficit to GDP ratio over the full period with these more I would argue, realistic assumptions around just two items. And so for me, that's the one significant sort of nagging concern I have around the budget figures that we've seen. I do worry that the public sector wage bill remains unresolved and the SRD remains unresolved. The non-resolution of those two items towards what I think are more believable adjustments would result in a budget deficit of 4.6% rather than 3.3%. So for me, those are really, really important assumptions that are built into the MTF at the moment. Time will tell whether and how these will change. I should confirm or reiterate again that these are based on given growth projections, which may change, and so rising growth, therefore rising revenue, may end up paying the bill for public sector wages and for the SRD, right? So what that does is to possibly maintain the deficit to GDP ratio on its current path, but I think those are massive asks and those are numbers to be watched. I think ultimately historical precedent around budgetary requests that come because of political pressure that we've seen in the past means that the sort of technocratic commitment is unlikely to win the day, at least based on past evidence. I think there's an outlier risk around where the funds may come from, and I'll come back to that later. And in particular, the GFECRA is one area where government may be tempted to start looking at dipping into, but we'll come to that later. So if one thinks about those outlier concerns, let's move then a little bit to digging just one level down in terms of the budget documentation and looking now in more detail at the GFECRA and what the revenue projections are looking like, as well as a little bit around the SOE bailout situation. So just to be clear, the gold and foreign exchange reserve account, what does it do? It captures these unrealized gains on South Africa's foreign exchange reserves, right, due to exchange rate movements. So a dollar, in 2006 is worth far more in rands now than it was in 2006. And essentially, that's the point around the reserve account, right? That the weakening of the rand, right, has seen this massively rising surplus. Essentially, it's the weakening of the rand. Massively rising surplus in the GFECRA balances. And so specifically that balance has grown, and you can see it there on the graph on the left, from about 1.8 billion in March 2006 to 507 billion currently. Now, what is the account? The account has been used most of the times by SARB to manage currency swings, right, as part of the dirty float exchange rate regime, and as we'll see, for sterilization purposes. The National Treasury's view, which I think, to be fair, is the correct view, is that this account and the value of it is now larger, right, than any sort of plausible foreign exchange losses that we likely to see from the rand appreciating. So we're not going to go into deficit in this account, right? It's not as if the rand's suddenly going to strengthen to 10 rand or 5 rand to the dollar. And so the proposal coming from Treasury as part of discussions with SARB is to utilize some of these foreign exchange gains, right? The surplus that's sitting in the GFECRA to actually support expenditure commitments. Now, if I come back to my point, it is possible that in order to meet a commitment, a political commitment or a difficult commitment to politically extract oneself from around SRD or the public sector wage bill, there could be a temptation in future years to turn to the GFECRA to resolve these, and that's up for debate. And I think the question then is, what is the framework around the GFECRA? So what the framework that Treasury has settled on, and that's very, very clear, and I don't think, again, that's been emphasized in the media sufficiently, is that there is a formal agreement, of course, right, between National Treasury and SARB around access to the GFECRA. It's not sort of an open door policy. So the framework as it currently stands is that there's sort of a three-bucket approach. The first bucket is the GFECRA will retain funds to absorb any of the exchange rate swings. So that's really important, right? So that's the first order of business, right? If there's a failure, so in other words, if that reserve account's too thin, right? Well, then the obligation sits with National Treasury to cover the exchange rate losses. So of course, there's everything in National Treasury's interest, if it's technocratically carefully managed, which I think it will be, to ensure that it doesn't dip too far into the reserve account when it may be facing uncertainty around exchange rate losses. The second bucket is a SARB contingency reserve, which I mentioned in the previous slide, and that's essentially for the SARB to pay for both sterilization costs, right, as to manage capital inflows, to neutralize the interest rate impact that may arise from massive capital inflows, and I think also to generally manage foreign exchange movements. Once those two obligations are met, and those are technical decisions around those values, and one would need to look at historical values, one would need to look at confidence intervals and margins of error and so on. But once those reserve values are settled on, it's only then that remaining funds can be distributed to the National Treasury. So I think that's important as a framework. I think that would guide future access to GFECRA. It's not watertight, but it's certainly a useful framework to keep an eye on. Just to note that this kind of reserve account and the use of it is not unusual internationally. I would worry just again around political interference, the changing of thresholds, that margin of error, if it suddenly changes in the billions, may be a technical decision, but it may lead to outcomes that are negative for the fiscus if the numbers are interfered with to pay for other bills, such as the public sector wage bill or the SRD. And so I think what all this points to is the need to monitor the GFECRA, monitor the framework, and ensure that both on the SARB and the Treasury side, commitments are maintained. So if one turns now to income tax collection, which I think has been under significant pressure, we have a position now, at least based on the budget documentation at the time, these numbers are changing, of course, where revenue for the current period was 56 billion less than expected in the 23 budget. So the projections come in under, and this has been disproportionately due to the decline in corporate income tax. And I think that speaks to the difficulty in the corporate environment. So you've seen in particular, and the graphic on the left shows that revenue from mining and manufacturing in particular has collapsed. That's not just South Africa's long run, as I've called it before, the deindustrialization challenge in South Africa, but I think it's also global factors. So we don't have the resources run that we had last year. China is struggling, so that means foreign demand, particularly from China, for resources is flat. Global growth is flat, and so resources are struggling, and hence revenue is not forthcoming from the mining industry. But also to blame, as I've noted at the beginning, is our domestic infrastructure collapse. That has made business so much harder to do and has curtailed revenue collection for SARS. But also what we've seen is, if you just take outside of those two sectors, is a struggling corporate sector in general. And as a share of gross tax revenues, what's really important is corporate income tax as a share of gross tax revenues actually decline from 20% in 2022, 2023, by 3 percentage points to 17% in 2023, 2024. So I think that's almost a headline to take away, is that forget all the noise around business. If we wanted to, let's abstract from the business sector and private sector complaining about infrastructure or complaining about corruption and wastage. Forget all that, right? Let's look at the numbers, right? Let's look at profitability and the revenue generated for government, and that's declined, and it's declined dramatically. So I think it again speaks to the really centrality of turning the economy around in a manner that will grow and increase revenue collections dramatically. So unfortunately, one thing that has happened is because of this decline in corporate income tax, we've seen bracket creep used as a instrument by the tax authorities on personal income taxes, and that essentially will allow for an increase of about 50 billion in tax collection from individual taxpayers. And so to some extent, to square that circle, we've seen individual taxpayers suffer at the hands of bracket creep. If one turns to state-owned enterprises, I think it's important just to keep in mind these are all figures that come from National Treasury. What a difficult, let's call it sort of albatross, fiscal albatross. This has been around the neck of National Treasury. And some of these numbers were shocking to me, to be honest. I look, for example, at the table on the left, which shows the combined balance sheets of all state-owned enterprises in South Africa. And what's very, very clear, if you look at the last row, is that the return on equity for every single year, the return on equity for every single year from 2018 to 2023 for combined state-owned enterprises in South Africa has been negative. So that, for me, is a deeply worrying state of affairs for a part of the economy. Just recall, if we think of energy, if we think of rail, roads, ports, water, for part of the economy that's supposed to be crowding in private sector investment, for part of the economy that's supposed to be facilitating the state as a development leader, if you like, is some of the discourse that we hear about in industrialization and industrial policy, is deeply worrying that you've got this part of the economy that's dysfunctional, essentially. If you look at the data on the right, you find that on average, state-owned enterprises have been operating with negative cash flows consistently for every single year, financial year since 2018. And so that just speaks to the inability of state-owned enterprises to play their core role. There remains a concern around the extent to which government would be offering bailouts to these inefficient and corrupt SOEs, and these sit in what are known as the contingent liabilities. The contingent liabilities, just as a reminder, are those state obligations that will be activated if a specific event occurs, such as a default. And so these total approved guarantees to state-owned enterprises are published, and they sit there in the MTF, and you see that those are expected to increase marginally to about 503 billion from 433 over the fiscal year, and the exposure amount will actually decrease slightly. The key point here, though, is that Eskom accounts for 85% of the exposure to public institutions, and that's something that's been baked in, and we understand the background to this. What one was worried about was continued exposure to, for example, Transnet and other institutions. The Transnet exposure has been curtailed, so it's been managed. It is there. The guarantee is sitting at 50 billion, but it's much lower than would have been expected. One does have concerns, for example, around Sanral, which is an ongoing exposure that one needs to keep an eye on. So in thinking through, and this is sort of as we close off on the presentation, in thinking through some of the new proposals that often Treasury sticks in right at the end of the budget documentation, the one that's most relevant to listeners of the podcast that are in the Sygnia world, hopefully, is the two-pot retirement system. Remember, those would allow retirement fund members to make withdrawals while they are still active members, so before retirement, and no need to resign to access part of the retirement benefits. And so the commitment still remains that this reform will come on stream by the 1st of September in 2024. Where we stand is National Treasury has noted that they're finalizing legislative processes over the next few months. And this would ensure that industry and regulators can prepare for implementation. So I think that's where we stand, and that seems to be a firm commitment. I don't think there'll be a deviation from that date. And there've been some concerns that the elections may change this, and I'm not convinced by that yet. The other two important announcements were around a global minimum tax. So just to be clear, this is not something South Africa's plucked from the sky. South Africa has been involved in a joint steering group with the OECD and the G20 around base erosion and profit sharing, particularly around large global corporates. And the outcome of that discussion, one was around the digital economy, but the second one, more important, was the tax treatment for multinationals. And so the result here is a global minimum tax targeted at multinationals with revenues exceeding 750 million euros. They will be subject to an effective tax rate of at least 15%. And that tax is invariant. It's agnostic to where profits are located. So that, again, gets at the sort of profit shifting and base erosion challenge. So the budget estimates put it at about an 8 billion positive kick to revenue from 26-27. There's also the Financial Action Task Team progress. I've been disappointed by the lack of progress here. The latest we've heard is that all remaining actions and improvements will be done by February 2025. And so we hope that National Treasury will remain on track. Then there's some minor notifications around crypto asset policy and tokenization, as well as an electric vehicle incentive, which stands at about 500 million. So ultimately, if we look back at the presentation and the budget documentation, I do think there are a couple of important conclusions, and one must not cherry pick sort of pieces of evidence. So if I put it together and I ask myself, where do we stand with respect to the budget? I think we have certainly returned to what I call our early post-democracy roots under the sort of Thabo Mbeki era, where we had very careful fiscal management and transparency. I think we have returned to those roots, and that's manifest in the peaking of most debt indicators, and also the resistance to additional bailouts for state-owned enterprises, and also what I've called the sort of the technocrats are back in charge at Church Square. And I think that's very, very clear. So I think the intention is there. But the risks for me remain, and those risks are outside of National Treasury, and those are primarily born out of political and social pressure, if you like. I've isolated two of those key risks. I think they lie in the public sector wage bill assumption and the social relief of distress grant assumption. I think both of them, certainly the numbers as well as their continuation in the current documentation, are not credible. I think we're going to see higher wage bill adjustments, and the SRD will remain, or some form of it will remain permanently on budget. So I think those kind of deviations will place the deficit and other metrics under pressure. So they're big expenditure items. And so if growth doesn't deliver, if growth doesn't save us, if you like, or resources run, so the ceteris paribus remains, then those deficit targets won't be met. I suspect we are going to find ways in which to mitigate those the deficit increase through, if you like, the positive outcome from growth, or a resources run, or even dipping slightly more into GFECRA. I think there'll be ways in which a solution will be found to moderate the deficit while still meeting the public sector wage bill and the SRD commitments. That being said, for me, the biggest worry is, yes, we can possibly muddle our way through the wage bill and the SRD. What we've done is to try and finance consumption expenditure. There's very little in the budget documentation around what I call supply side economics of a good type. Ultimately, the only way to kickstart growth is to get the supply side of the economy, get firms to be more productive, to be more profitable, and to ensure there's an enabling environment for South African firms to kickstart growth. For me, that supply side economics is almost a maturing of our budget policy commitments, and it'd be good to see them lying at the heart of any future budget policy statements. Well, that's me for now. Thank you very much for joining and listening in to this podcast, and I look forward to future engagements. Thanks very much.